everyone, we're joined today by Phil Oakley from Outserve, one of the UK's top e-commerce accounting integrators. He works with Amazon and Shopify brands that you might recognise here in the UK, along with his team. And in this video, we're going to talk about how to choose the right cost flow method for your e-commerce business. Your cost flow rules will decide which landed cost layers turn into the COGS every time you make a sale. And we've got other videos on COGS, which you might want to check out, that we'll add down in the description. But first of all, thank you for being here today, Phil. Tell us a little bit about yourself quickly.
Thank you very much. Yeah, I'm Phil Oakley, owner and founder at Outserve. And at Outserve, we have a specialist team working with some fantastic e-commerce brands, helping them scale and grow, really understand their numbers, and give them actionable data to make strategic decisions.
Okay, so first of all, in this video, let's just start with why cost flow matters so much for accurate cost of goods sold. What can happen if a brand uses the wrong method, or worse, mixes up their methods?
Yeah, so I think we can get straight into that. Obviously, I think we've got the slide with the different sort of stock valuation methods, and I think at the top three, obviously talking average cost, LIFO, last in first out, and FIFO, first in first out. And I think on this it is really saying that for different countries, for the differing accounting standards. So in the UK, whether it's I think IFRS or UK GAAP, then LIFO isn't available from statutory compliance accounting anyway, where it can be in the US GAAP. So it would just leave the FIFO and an average. But I think there's some key things to think about straight away between the different methods, because it will actually change the profit that you're showing every month. We often see this where the costs are rising or costs are falling. So in the first in first out methodology, if you were buying a product 6 months ago and that was costing you less than it is today, then you're actually going to charge your cost of goods sold account for a lower amount. So you will actually appear more profitable and actually be showing a higher value in stock, and then vice versa the other way around with last in first out. So there's lots of things for businesses to think about in even just the profitability that they will show with the different stock valuation methods. Clearly some businesses might want to be tax efficient and may want to show a lower profit and be more up to date with higher costs when costs are rising. Other people, again, maybe looking for investment, even looking to sell their business. So maybe incentivized to show the larger profit based on a consistent method. And I think that's the most important thing. None of these stock valuation and cost methods are wrong. Certainly not from any management accounts in any country, but to be consistent. And that's so important internally, because you want to compare like for like. If you want to look at what's my profit right now today compared to what was it this time last year, which we know so many businesses want to do, to have that sort of comparison, well, you need to use the same costing methodology. Otherwise, your comparison really isn't going to help you. You're not comparing like with like.
Yeah, and consistency is such a big thing in this area. What do you see if they've mixed up methods? So if a brand or an online store has mixed up methods, what are the outcomes of that, the potential negative outcomes of that you've seen?
I think they're giving you, unclear or incorrect data that you're making decisions on. And when we've seen such price volatility, when we've seen supply chain shocks, you just think, we do a lot of business in food and beverage, where we might feel it at the cost of living when we go down to the supermarket when we see these prices going up. But that can make such a difference to the business in the food industry. If you're a coffee roaster or a coffee company, and we've seen significant changes in the price of coffee, and often an increase in that coffee. If you're having an inconsistent method, you're giving yourself some information. You're looking today and going, right, how much profit am I making today, and make a decision. You can make the decision of how much can I spend on advertising, what channels should I be selling on, what products should I be promoting. And unfortunately, that data that you're trying to base that decision on is actually not up to date or correct or inconsistent, which is really not going to help you make those strategic decisions for the best interests of you and your business.
All right, before we get into how to choose the right method, could you give us a quick refresher on the three cost flow methods, Philip?
Yeah, absolutely. So shall we start with, one which is quite common and popular, commonly known as FIFO or FIFO, depending on how you want to pronounce it, but certainly first in, first out. And it makes some sense, especially for food and beverage businesses and people who might be concerned about expiry dates, best before dates, because you really want to get rid of your oldest stock first. So, and from that point of view, then as you take that stock out, it will be the oldest purchase price that's coming out of stock. I think, as we've explained before, that's going to have an effect if you've got rising prices or dropping prices on the profit and loss. But it's really looking for taking that first item in that came in first, out first, which is often matches, and this is quite an important point. It's trying to match the reality of how the business works, and really your cost method, your stock valuation should be as best as you can match the reality of how you're actually picking the products, and it's how we'd recommend that most businesses would probably do it.
That makes sense. And so the second one, what would that be, Phil?
So we'll go as a second method, but following on, obviously we can talk about LIFO because it is the near exact opposite, last in, first out, which would mean essentially you're giving your customer the last product you bought, the most up-to-date one, which you can't probably think of many businesses that would actually do it in that way. But it is certainly a valuation which straight away takes into account what today's cost is. So when you're thinking about profitability and you're thinking about maybe rising costs again, that if you're costing on a LIFO basis, even if you're picking in a different order, if you're doing it for accounting, you are attributing the most up-to-date cost to cost of goods sold, and updating that profitability. As we've touched on, it's not always accepted for statutory and compliance accounts in various countries under various accounting standards. Could be used for management accounts, and it can be used in the USA.
Yeah, that's a really good clarifying point there. So we've got FIFO and LIFO. What's the third one?
And this is a really important and interesting one because it's weighted average. And there's a couple of things to really think about when you've got a weighted average. One, it's very well supported by a lot of the software out there. So when we touch on inventory management software, many inventory management software can do FIFO or LIFO, but it's a very popular method to calculate on weighted average. And that really is looking at everything you've bought that's in stock. It's very important to consider the calculation only goes on what is actually in stock and has been purchased and weighted by those quantities and comes up with an average price. This actually takes some of those spikes out of the LIFO and FIFO calculations and makes more of a sort of easier to understand, and eases the price volatility across a management accounting period. So can be very, very popular. It's easier sometimes to calculate and to follow, and it's often better supported by inventory management software, and maybe in some people's view in management accounts maybe a fairer and truer reflection of a company's profit depending on their products and trading style.
Okay, so I think it would be great, Phil, if you could just walk us through this cost method decision chart, and just when you're helping a customer in this way make these decisions, just talk us through the logic and how you would walk them through this decision tree.
Yeah, so I think this is a good decision tree, and as you would know, Elspeth, there is never a 100% hard and fast rule, but I think this is a really good start. So I think if we start at the beginning, are your purchase prices stable month to month? And many businesses do have stable prices. Then maybe that's a yes. Then a weighted average is going to be going to be good for you. It doesn't necessarily mean that it wouldn't fit all of the time, and absolutely happy to have a conversation with anybody who would need to. If it's a no, maybe we can go a bit further on and then it's do you sell under IFRS rules? IFRS rules are really for UK businesses that we're thinking of here, because we know that they're not going to be able to use LIFO, so it's going down the tree here. And then your choice, if it is yes to IFRS, then we're going to have to go LIFO is not allowed. And then again, they can go weighted, and there's good reasons to go for weighted, as we've covered in the past, or they could go for FIFO, but LIFO is not going to be a choice. Now, if they're not doing IFRS or a US business, etc., then we've got these decisions about, do you have a preference about having more profit and paying more tax? So the question is lowering taxable income a priority this year? And you say, yes, it is. I want to, lower that income and that profit. I want to pay less taxes. Then you could be looking at LIFO if you're allowed to pick it in your region. If it's not, and we're thinking about investors, do investors care about stock showing the latest costs, probably having more value in stock, more profitability? If that's yes, then probably going for FIFO. If it's no, again, we could go straight for one of the best methods, which is weighted average, probably the most simple and most supported stock method.
That's super helpful, Phil. Thanks for walking us through that. So I think the key from this overall video is just to pick the method that matches your circumstances, so price volatility, tax goals, and the reporting rules in your particular location, and then document it, apply it consistently, and lock it into all the systems that you're using. If you'd like personalised advice on this, we do recommend the Outserve team. They're real experts. We've included a link in the description so you can talk to Phil and his team if you would like to. Phil, thanks again for being here today. This has been a really helpful insight into it, particularly the thinking behind how you would make these decisions.
Thank you very much. Thank you for having me.